Good morning, everyone, and welcome to our DAT IQ weekly market update. This is our update for April 5th, 2022. I'm Ken Adamo, Chief of Analytics here at DAT, joined by Ned Damon, who's our Principal Data Scientist, and Dean Croak, who's our Principal Industry Analyst. Good morning.
Good morning.
Good morning, Ken. Hey, Ned.
So the big question is the freight recession real or just a state of mind?
It's vibes. It's all vibes, Ken.
Feels too early to call. Like there's so much unraveling at the moment.
Dean, it's a black swan. Didn't you know that? It's a black swan.
Wow.
Thank you, Professor Talib.
I feel like sometimes I'm reading like the Dr. Nick of freight forecasting. Hi, everybody.
Yeah.
But in all seriousness, we are here every Tuesday at 10 a.m. Eastern, helping you navigate these freight markets and make informed decisions about what's actually happening out there. Because in all reality, we joke to lighten the mood a little bit. We could very well be heading headlong into a freight recession. And I think the best possible thing that we could do, that we would encourage you to do, is to look at the data, take advice from seasoned experts, and make the best business decisions you can. Because you're not going to just stop doing business because we're in a freight recession. You're going to have to still operate and find capacity or find loads, depending on who you are, and make money. That's what we're all here to do, right? Yeah. So with that, I'm going to jump into our key points of the week because we obviously have a lot to talk about. So dry van spot line haul rates, we're sitting just a penny over year over year. We haven't been year over year negative since June 2020. That's crazy to think about, right? So we are right on the cusp for dry van spot line haul of being year over year negative. Interestingly, I don't have a chart for it here, but if you're interested, you could reach out. Year over 2 year, so like year over year, we are still tremendously positive. So again, nothing to freak out about. Reefer spot rates are down a little bit year over year, but flatbed still holding steady about a quarter over year. Demand, we had end of month, end of quarter just wrap up. A little bit lackluster. Load to truck ratios did tick up, but total loads perhaps did not. Bit of a soft produce season, it looks like. It's been cold. A really interesting link between fertilizer shortages and perhaps a diminished growing season. That's going to be something to watch. I know eggs. I just saw in the news this morning, eggs could go up to 50% in price due to some of the issues that they're having there. March factory activity stumbles. And we saw transportation employment down sequentially for the first time since April 2020. So to make sense of all that, I'm going to turn it over to Dean, and he'll walk us through the market update. Dean?
Yeah, thanks, Ken. Fair bit to cover today in our market update. Remember, as always, we publish the long-form version of the report on Wednesday evenings at dat.com/market update. So let's kick off with a look at the load-to-truck ratio. Ken mentioned there was a little bit of change last week. The load-to-truck ratio moved up slightly, back over 4. So ended the week at 4.30. Load post volumes are up 6% last week, but still down 22%. In the last month, and down about 9% compared to this time last year. In the refrigerated sector, there was a slight bump in reefer load post volumes last week, up 5%, very similar to dry van, still down 28% month over month, and down substantially about 26% compared to this time last year. The market's definitely cooling off ahead of produce season. It hasn't quite kicked off yet. Load posts, the combination of load posts and carry equipment posts pushed the load to truck ratio up to 7.63. It was about a 10% week over week change. In flatbed, load post volumes were down last week following 4 weeks of gains. Volumes are still about 9% higher year over year and about 25% higher than this time in 2018, which was, of course, when we had the last big flatbed rate rally. Carry equipment posts were flat last week, so as a result, the load-to-truck ratio dropped about 2% to 83.64. Having a look at our market index, market condition index around the country, big change this week in Houston. We've got to spend a little bit of time on that today because it relates to the port congestion on the West Coast that's been easing, down to 35 vessels waiting to unload. That's down from 109. So it's down substantially since the start of the year. But it hasn't stopped importers redirecting loaded containers to any other port not named Los Angeles or Long Beach. The Gulf Coast to Port Houston has been one of the larger ports to benefit from the coastal shift to what we saw last in February from the Piers data. Import volumes in February were up 37% year over year. Furniture imports, which of course is one of the biggest import commodities nationally, was up 9% year over year countrywide. But in Houston, furniture volumes are up 17%. Most of those shipments come from mainland China, where total volumes are up 39% year over year in Houston. That's imports from China up 39% year over year. Of course, that means a lot of the Neo-Panamax vessels at about 12,500 TEU that fit through the Panama Canal are making their way to Houston instead of going straight into Los Angeles. And we're even seeing impact in the truckload market for loads all the way back to Los Angeles and Ontario out of the Houston market. So what it meant for us this week, truckload volumes in Houston became the number one dry van market for load post volumes last week. Volumes are up 27%, following last week's 4% week over week increase. So they're up 27% in the last month. Plenty of capacity though. Rates were down by about 11 cents per mile in the last month, averaging 235. Back on the West Coast in our largest port, load post volumes in Los Angeles continue to slide, down 4%. Rates are averaging 241 last week after decreasing by a penny. And on the lane that we've been watching closely in the last 18 months, Los Angeles to Chicago, where we compete with intermodal, rates hit $2 a mile, excluding fuel. That's now 43 cents a mile lower than the previous year. So lots of easing of capacity, decreasing of volumes on the West Coast, increasing volumes on the Gulf Coast and East Coast. Having a look at the refrigerated market, produce season is certainly cooling off. Spot rates have been dropping for 3 weeks in Florida. In Lakeland, rates are up just slightly, though. It's just north of Miami where rates were down. In Lakeland, rates are up to $1.74. Loads to Hunts Point in New York were paying much higher at $2.38. Loads to Atlanta were down to $1.74. That's an interesting one. That's probably one of the busiest lanes out of Lakeland Market to Atlanta. They're 42 cents per mile lower than this time last year. So that Florida produce market is certainly cooling off rapidly. In Jacksonville, short haul capacity was the big driver of rates last week. Spot rates jumped 28 cents a mile to an average of 278. Load post volumes are up 24%. Out west in Fresno, that market's starting to come alive. Load post volumes are up 45%. It's where most of our produce nationally comes from consistently year round. Plenty of West Coast reefer capacity, though. Spot rates decreased 3 cents a mile in Fresno to an average outbound rate of 279. Loads north to Seattle, is another busy lane out of Fresno, were flat at 334. Loads east of Phoenix, it's another busy lane out of Fresno, we're up 21 cents a mile to an average of 291, excluding fuel. Having a look at the market condition index for flatbed, after dropping in the 3 prior weeks, flatbed spot rates in the largest steel producing market in the US, in Gary, Indiana, increased by 10 cents per mile last week to an average of $2.70. Loads to Omaha out of Gary were down 15 cents a mile to $4.47. Loads from Gary to St. Louis, Missouri dropped 40 cents a mile to $4.04. So still high historically, but certainly going down. In our number one market for load post volumes and loads moved is Houston. Capacity tightened slightly last week. Rates increased 12 cents a mile to an average of $2.93 after easing in the 2 weeks prior. Up in the Pacific Northwest, as you can see, there's a lot of hot colors there. Flatbed capacity remains very tight in Portland and Medford. A lot of lumber comes out of those markets. Spot rates jumped 20 cents a mile last week to an average of $3.11. Loads to Portland and Portland to Stockton were up 15 cents a mile to $3.11. That's 24 cents per mile higher year over year. That's Portland to Stockton. And Portland to Los Angeles loads increased by almost 30 cents a mile last week to an average of $2.79. That's about 35 cents a mile higher than this time last year. So lots of increasing rate activity in flatbed, as we'd normally expect to see seasonally as the building industry gets going. Having a look at the year over year spot rate activity, dry van spot rates are now just a penny per mile, as Ken covered. They dropped another 4 cents per mile last week, down 30 cents per mile in the previous 4 weeks. They've dropped by about 43 cents a mile since the start of the year. So 43 cents per mile year to date is the downside, averaging 235 this week, excluding fuel. In the refrigerated market, after dropping 6 cents a mile the week prior, reefer spot rates dropped another 6 cents per mile last week, and now about a penny per mile lower than the same week last year. They've dropped 53 cents per mile since the start of the year. Spot rates decreasing in the first quarter are not unusual, of course. In the previous 5 years, reefer rates dropped on average by 22 cents per mile in the first quarter, except for except 2020. During the year, this year, they've decreased by 54 cents. So they've increased by about double what you would normally expect reefer rates to drop in the first quarter. Flatbed, wrapping up now, flatbeds spot rates were mainly flat last week, ending the week where they started at $2.71, excluding fuel. They've increased by 4 cents a mile since the start of the year and are now 27 cents per mile higher than the previous period last year and about 45 cents per mile higher than the same week in 2018. So that's it for the market update. Remember, if you'd like to find out more about what's happening in freight, go to dat.com/market update and download our weekly report. And with that, it's over to Ned for the short-term forecast.
Hello, we're going to be beginning with our national spot dry van look. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast models. There's pretty broad model agreement as we head into the first couple of weeks of April, with the short-term forecast in red and the ratecast forecast in green, both agreeing about a drop of 20 cents is likely to occur. However, once we get in past the mid part of April, there's a little bit of model disagreement with ratecast in green, expecting rates to level out a little bit and hold, whereas the short-term model is expecting a continued drop of another about 20 cents per mile. In gold and silver, although it's hard to distinguish them because they are pretty similar in this case, are our blended forecasts, which are mixtures of the short-term and ratecast forecasts in different amounts and in different ways. And they both are leaning more towards the short-term forecast, although they're having a break a little bit later, not quite dropping as far as the short-term forecast. Next up, looking at reefer. Once again, in blue, you can see the market rates observed by DAT. And then off to the right, you can see that there's pretty widespread model disagreement between our various models. Ratecast in green is expecting a continued drop of maybe another 15 cents, but then leveling out as we head into the standard growing season, with loads being able to be moved by about the middle of April at prices that are not too far off from current. Short term is a little bit less optimistic, with rates dropping by about 60 cents over the next month in the short-term model, which I think might be a little bit aggressive, and that short-term model is in red. And then in gold and silver, you can see our blended forecasts, which are mixtures of the two models in different amounts and in different ways. They're leaning, again, a little more towards the short-term model, but breaking when we get into the middle part of April, with the rate of decline slowing down, although the overall decline being somewhat maintained. Finally, in flatbed, you can see that there's a little bit more, less dramatic movement in our models. In blue, you can see the market rates observed by DAT, and then off to the right, you can see our forecast. In red, the short-term model is expecting rates to stay about where they are, and just proceed forward with a little bit of variation. In green, you can see the ratecast model is expecting rates to drop by about 5 to 7 cents before regaining most of that drop in the later part of April. And then in gold and silver, you can see our blended forecasts are leaning a little bit more towards ratecast here, with a drop, although not quite as strong of a drop as you see in ratecast. And that is enough for the short-term forecast, which brings us to our IQ question of the week, which is, how has recent market volatility impacted long-term rate forecasts?
It's a good question, Ned. So for this, we prepared our long-term spot line haul forecast for the dry van, reefer, and flatbed. So without any further ado, we're just going to roll into the dry van one and walk everyone through that. If you're interested in these forecasts, just drop us a line at askiq@dat.com. If you have any questions, just drop it in the chat or comment section below, and we'll get to that as it comes. And pardon me while I'm ignorant and look at the screen because I can't see. So what we have first is the dry van. And I think what's really important to call out here is if you look right around this time last year, we saw the market really wanting to correct. Now, what we don't know is what would 2021 have looked like had the polar vortex not hit and then Delta not. I think the first observed case of Delta was about a year ago. Someone correct me if I'm wrong, but I think that was probably about it in the United States anyway. I think it was like end of March, early April. So what would that year have looked like had those two things not happened? Would we have been having these discussions? Would it have been the beginning of the correction as opposed to another huge up year? Where we sit now, things are looking very similar to that correction period last year. Ratecast seems to think I would pretty much disregard the green line. That's just hopeless optimism, in my opinion. Been wrong before. We'll be wrong again. But that, to me, just seems like at this point in time, those are the people that are like overly, like obnoxiously optimistic. Ratecast's baseline model has us bottoming out here probably until late April, early May, and then starting that seasonal push into the 4th of July.
Ken froze.
Ken froze.
Wow.
Okay, it wasn't just me. I was
Right.
so I'll continue forward. Yeah, it's bottoming out as Ken was saying in the May-ish, April, May, and then there's a sort of upwards seasonal pressure overall. It's expecting that from the bottom of the correction, rates have a little bit of growth left to give, but we are still going to be ending the year well below where we were in 2021. So keep that in mind. That's that blue line. I think it's important, Ken may have skipped over this, but to call out, we give 3 different kind of forecast scenarios. We tend to summarize them as like the bear market, the bull market, and the sort of default. The bear market in green, the bear market in red, the bull market in green, and the sort of default in blue. All of these forecasts are expecting a continued drop by a non-trivial amount, although the depth of the drop varies considerably depending on which case you're looking at. And then the shaded area below the chart, which is up against the right axis, is the year-over-year comparison for the middle case, for the blue case. So I think it is important to talk about the bear case here, the red, where we have a drop, and then there's basically no regain. Oh, we're back. Ken's back. All right. Hold on, he's still backstage. We're gonna usher him back on. There we go.
What did I miss?
Right.
What did I miss? I heard a loud bang somewhere in the building, and then my internet went out. What did I miss?
I was going through and explaining what the various lines mean and the shaded area means, and it was trying to cover the basic cases and explain that we were just getting into the bear case of drop and then basically no regaining of ground.
Did you hear anything I said about this time last year?
Yes.
All right, good. Was there anything really left to say here other than the red line's probably, or at least where my betting, if I was a gambler, where my betting line would be?
I mean, the only thing that I could see that would make a case for the green line is if we had another COVID variant that was as bad or worse than Delta, that would do that same kind of anti-correction that we saw back last year after the polar vortex. But you'd also want, again, if we wanted to repeat the polar vortex story again, there would also have to be some big disruption to a major freight market. So I think that's about it.
All right, let's head on to reefer here, because I think it's really interesting here. We've seen a bit of a sharper correction, right?
Yes.
I can't really tell if the slide's advanced, but we're on the reefer chart.
It's advanced, yes.
Cool. So I think on this one, again, I have a hard time believing the green line. We start to see a bit of a quicker bottoming because of the typical seasonal push with produce. So that would be the blue dotted line. Again, everything means the same. The gray shaded area is the year-over-year change. Blue dotted is base case. Red dotted is bear case. Green dotted is bull case. The blue line pretty much has the year ending where it started. Kind of produce that summer cooling off and then ramping up into the fall. Again, if I was placing bets here, I think the red line is probably more indicative of where we end up, with a little bit of a bump heading into produce and then a bit of a slide before we have that, again, Thanksgiving bump later in the year. Any other thoughts?
I think that's where it lands. I'm with you on this one, Ken. I think the more bearish red line is probably more realistic given where we are right now.
Yeah.
which isn't the case. See, this is a beautiful segue as we go to the flatbed chart.
Right.
Because in this instance, I think the red line is probably the least believable of the two. So again, everything means the same. Blue line, solid, is historical. Blue dotted is base. Red line is pessimistic case. Green dotted line is optimistic case. The shade is year over year. I struggle even to subscribe to the blue. I mean, unless housing starts are going to really crater and diesel goes back down, I have a hard time believing. I mean, the blue line is a very conservative outlook, right? What do you think, Dean? You're more connected to this market.
I think I'm erring on the side of the green one being more realistic, given where we are now. Capacity is still tight in the flatbed sector. There's still demand for steel. We've still got a lot of the volume from the infrastructure bill to come online. There'll be lots of activity with steel and lumber throughout the year. So I think the green one is probably more realistic based on
my experience has been that it's rather uncommon if you're typically hauling dry van and reefer to kind of decide to change things up and move on to flatbed. Is that your experience as well, Dean?
Yeah, it's a pretty specialized area, but just physically, it's a totally different business. You've got a lot of different equipment to haul flatbed. You've also got to have a completely different skill set than just drop and hook or dry van or reefer.
Which I think is an important point, because I think one of the fallacies out there is that, well, when dry van and reefer rates crater, they can just go to flatbed, which will, again, tank that market, right? Because you'll have a bunch of capacity entering that. And I just don't think that's true. I'm sure some do,
right?
But I can't imagine that there's a high degree of fungibility between dry van and flatbed owner-operators.
Right. Only power only would probably be the only way that would happen, Ken. Like it's not like you take the entire combination and swap sectors. Yep.
You don't just park all three trailers in back behind your house and grab which one's paying the highest rates.
Well, some do, but the reality is that not everybody does that.
Pretty rare.
Yeah.
I think that's really it for the graphs. I mean, ultimately, we started the show on a little bit of a lighthearted note, but I don't think that the folks out there talking about impending freight recession are that far off. I think things are very much pointed that direction. I think what I take umbrage with a little bit is the alarmist nature, right? Because what are you really going to do if you get all frothed up about it? You're not going to. You can just sit around and worry about it, or you can kind of put your head down and power through it. If I was entering the market, if I was sitting on the floor, let's just pretend that the Freightliner dealers were full of power units. If I was sitting on the showroom floor of that dealership about ready to sign on the dotted line, Dean, what advice would you give as we head into this? Because I really want to make this actionable, because we could spend this entire show kind of giving analogies about crashes, but what's like the prudent advice?
From a small fleet perspective, I could talk to the operator small fleet sector. It's right now it's about cost minimization. Like, it's about controlling your operating costs in particular, like all of your costs. I know that's hard with inflation and eating into your margins, but being extremely careful about load selection. And the one thing that I'm alarmed at right now is this sort of race to the bottom mentality where carriers are undercutting each other. That doesn't help anybody in the market. But then again, that's been happening on multiple continents for the last 50 years. So that's not a new phenomenon where carriers in sort of a free market undercut each other. But that'll not end well for the carriers that have a high exposure to debt operating in the spot market. So I think be very, very careful and be extremely good with negotiation. Make sure you understand your operating costs. They're critical things. That none of that's new. But this is the time to be doing it.
Yeah, and I think pivoting that to a broker's perspective, I would say this is the first time in 2 years, if I was running a pricing desk at a mid-sized to large brokerage, that I'd be pricing forward shipments cheaper than current spot freight.
Yep.
And that, if you're not paying attention to what we're talking about or other people that you listen to or read about, that I think is one of the huge messages that you should be gravitating towards is, if you're bidding in the current cost regime that you had in December of last year, you're most likely going to be losing across the board. Shippers understand that the market is turning. They're seeing their tender acceptance go through the roof. they know that they don't need to sign up for forward cost increases to secure capacity. So that is something I'd be very cognizant of if you're in pricing at a broker or a very large carrier where you're actually running RFPs, is to be mindful that I'm not saying you slash your current prices by 50% because then you're going to be on the hook for very unprofitable freight. I'm just saying you look at these forward cost curves that we presented, you're looking at all the data available to you. It should indicate that even if the market doesn't crash, it's most likely going to settle down at a point lower than where it was a few months ago.
Yeah. So to give like a positive spin on that, if you have a very good understanding of your costs and you can keep things under control, you can win a lot of market share by being able to accept lower margins and going forward with that. But that's a really high risk play.
Yeah, I mean, so I was reading some of these reports on and again, I want to make sure that I'm not piling. Again, I think a lot. If you pluck the alarmist nature out of it, there's a lot of really good content in some of these pieces, and one of them was around these short-term dips in price. Like, I don't mean that the price is short-lived. I just mean things fall rapidly. Is what I'm talking about. Those are really good periods of what they call like margin expansion for brokers. It's a way for a broker to say like, look. And it's not at anyone's real expense, right? The RFPs that you signed in December, for example. So you have a contractual relationship with your shipper. All of a sudden, you're filling that load by and large on the spot market. That spot market has went down. So you're in a period where shippers aren't pushing you to rebid that freight because they just put the RFP in place. You're still getting those loads tendered to you from that shipper, but all of a sudden you're able to cover it much cheaper on the spot market. So you're able to take hold of that margin expansion. And I think that might cause a lot of people to throw their hands up and go, why should brokers be making more margin? Because their volumes are going to go down, right? During COVID, during the peak of the high rates, there were much lower percent margins, but higher dollar margins and higher revenues, right? So it took more money to make more money. Typically what happens when these markets violently correct downwards is your volumes fall, but your margin per shipment goes up. And again, it's very important that you're plugged into these things because if anything falls out of whack, you lose, right? If you're not capturing this margin upside and your volumes are going down, you are making less money. The only way to make more money right now is to make more margin per shipment because you have less shipments to haul. So that's just something to be mindful of, is why this is very important. And if you're a shipper, I think it's super important to recognize what's happening. For the first time, you're seeing spot contract flip. You're seeing probably the highest tender acceptance you've seen since before the pandemic. That means less freight's making it to the spot market. These are all important things, whether you're a shipper, broker, or carrier, to be very mindful of. And we don't take sides, right? That is very crucial. Yeah. When we have new folks internally, they want to sort of run with a story or run with something. It's very important. We don't take sides. We offer transparency across all of our core constituencies, brokers, carriers, and shippers. And much like Forrest Gump, I think that's all I have to say about that.
Do we have some time for some listener questions?
What a rip.
Michael A. asks, what do you guys predict this holiday season will look like? Any thoughts on when the market will return back to normal?
Which holiday? I'm looking forward to Cinco de Mayo.
Yeah, right.
No, he probably means Christmas.
Yep. Yeah.
What do you think, Dean?
I like the idea of where our blue line is sitting. I think it'll be very much where we're at now by the time we get to the end of the year on our long-term forecast. It has it about where we are now at about 230, 234, I think. Yeah, about right. Well, it's going to bottom out, but we're at about 234 now. I think that's where we'll be at the end of the year.
Ooh, that's a hot take.
Mm.
I think that one point I want to make about this is when you talk about returning to normal, it depends on what normal you're referring to.
I'm looking at a line chart right now of that. Yes, you're exactly right.
I don't think if 2021 was your normal, I don't think we're going to go back to that. If 2019 was your normal, we might be going more back to that. But your cost basis is also good. Yeah.
It's crazy though, Ned. I mean, if you think about it, I'm looking, yes, 21 is probably not realistic. Pending, I don't even know the Greek alphabet that well. I love gyros, euros. I don't know the Greek alphabet that well. I'm looking at 21 So if you look at our national, like the same thing you see in Rate Viewer on trend lines, that same formula, long, dry van, line haul only, over 250 miles. We look at a daily ticker here. We don't publicize it because it's noisy, but we look at it. We're currently sitting as of yesterday at 232 a mile nationally. Okay, that's that 1 penny difference we were talking about. Black Friday-ish 2020, so last year was 227 a mile. Black Friday-ish 2018, 178 a mile.
Right.
Yeah, no.
So, and at the time, that 178 was the highest on record by 20 cents, right? 2015 was a big year for freight, and we were at $1.56.
Yeah.
So there is a lot of... Now, I think before Dean jumps in, right, I know what he's going to say, like operating costs, it's a much different operating cost landscape now than it was then. The question becomes how much systemic inflation was put in place as a result of this. And I think that's what's going to determine where this thing bottoms out. Where this bottoms out should set a new level of where the low point of where trucking rates can go before they enter a new cycle.
Right.
So we're in uncharted territory, but it's going to be very important to chart this territory because I think it'll become very important in 2024, 2025, when we've already went through another up and down, because it should tell us how far it could come back down. So we'll see.
Matt Clark asks, seems like the downturn is happening. That's Matt Clark's opinion. But what are your thoughts on the impact of shutdowns in China, Shanghai, etc.? Will this have a ripple effect in the United States? In what way, upside or downside?
I think it'll be a downside impact because of the volatility at the ports. I think it's going to cause people it'll be impacting capacity, the cost of getting 40-foot containers, the lead time that shippers are going to have to put in place to get the goods. It'll be a repeat of last year, I think, in particular out of the biggest port in China. But I think the other thing, Matt, we're seeing is that the people are, especially with the West Coast Labour Agreement due in July, negotiations are starting now. There's already rumblings of importers looking to avoid the West Coast and ship volumes to other areas. So what we could see is just more congestion in other ports as a result of both the COVID shutdown in Shanghai and the West Coast labour talks.
Yeah, I mean, we need to get to a point where one little issue, not to diminish, it's a big issue for them. I don't want to put my foot in my mouth, but like one issue can't send the entire. I mean, the way we were trending, it's like if Bob at the Old Dominion terminal in Northwest Texas gets sick, we kind of throw the entire trend into his. I think at a certain point we need to move to a point where we're back to somewhat of a normal. Where okay, well, I mean, the Port of LA, just in my time in this industry, has struck like 3 times. So Oakland picks up the slack. They might deviate things around through the Panama Canal to the extent that they can. They might go up to Vancouver or Washington. So, I mean, the signs that I'm seeing across the entire supply chain would seem to indicate that we're seeing the overall pressure come off, where you can start to use intermodal again, or we're not stacking containers and starting to charge surcharges and all that, where we can probably survive a little tiny disruption here or there. I'd love to be doing the show where we're hyper-focused on one issue in one part of the country. Not, this is fine memes for 2 years.
Hunter Mathis
Maybe that's wishful thinking, I don't know.
Hunter Mathis asks, with the market trending downwards and driver costs still remaining high, how do you think the market will react as we start to get into the produce season?
Well, it goes back to the question 2 questions ago. Ken was talking about where the market lands. That's why I thought at the end of the year we'll be not far off where we are now. Operating costs for everything are up, not just diesel, but everything. Driver wages is a huge component. So we don't know where diesel's going to land. There's a lot of volatility in that market. There is certainly a downward trend emerging in average retail prices at truck stops, but we're still a long way from where that comes down to being sort of at a sustainable level from a viability perspective for all carriers, not just small operators, but large contract carriers that are running large fleets. Their operating costs are incredibly high. So my thought is that the market, we have a new floor. We don't go below where it costs to run a truck. Operating costs are up at least 30 cents a mile in the last year, maybe higher for the smaller operator that's not buying fuel at a discount. My numbers tell me that for a single truck owner operator, operating costs are up 50 cents per mile in the last year. So that's getting you up around $2 a mile to run a truck and trailer. Probably less for the larger fleets that have some purchasing power on volume. But that's a lot higher than it was certainly a year ago. And that's why I think we won't see the drop that we normally do. I keep going back to
that's going to be the big question, right? Where do we bottom out? 2018, for all that everyone went through, the second half of 17 and the first half of 18, we saw relatively, negligible systemic inflation put in place. Everything that was gained was given back in 19. Mm-hmm. Given the driver pay increases and a bunch of the other underlying operating costs, I don't see that happening here. The big question, though, is where does it settle out? Right. And one last point. I know we're running super long because this was like an epiphany that I think I was talking to Dean about this week. Brokerage has, by and large, most brokerages, the frontline positions are people straight out of school. Turnover is very high. People don't spend, the successful ones stay, but given that turnover is very high, time in industry is generally pretty low, right? Most people have had any experience in what it's like to operate in a down market. If you joined a brokerage in May of 2020, you have known nothing but historic, unprecedented in the era of deregulation. Boom. So I think it's just one of those things of the people that have been around, the people that have been seasoned, that have seen the ups and downs. It's really important at your companies, with your dispatchers, with your operators, with your carrier sales reps, with your frontline brokers, coach them through the fact that this market is very cyclical. The sky is not falling. We get through ups and downs markets. Brokerages provide valuable services when rates are up and when rates are down. Carriers are always providing super valuable services. Even when bankruptcies go up, we're talking about small fractions of the total driver pool, right? The overwhelming majority of trucks are going to be fine. Mm-hmm. And when your shippers' budgets get blown out some years, you make up money in others, but the freight still needs to move to run your core business. So just keep that in mind. We've seen ups, we've seen downs. We will continue to see ups and downs. It happens. Just need to manage through both scenarios.
Right.
So with that, what do we plug in? We got TIA this week in San Diego. Yep. I know Dean's flying out there. A bunch of DATers are flying out there. There's a big bash. I think we host Friday night this year. Is that correct?
Correct.
So that'll be fun. Dean, any other plugs before we hop off?
Yeah, we're on Sales Chatter again in the morning with Dan and DJ live at 9 o'clock Eastern, and then on Landline now on Channel 146 Road Dog Radio on Sirius XM at 7 p.m. Eastern tomorrow night.
All right. Sorry for the quick exit here, but we're running long. I want to thank everyone for joining us. If you do have follow-up questions, I already saw a couple notes come across for the long-term charts. It's askiq@dat.com. With that, we're going to sign off. Hope you have a great week. Talk to you next week. Bye.
Bye.